Hi, I'm Jack and welcome to the Attract Capital webinar series. Today I'm here with Attract Capital CEO and founder, David Barnett.
Hi everybody.
Today's webinar title is Safe Harbors of Funding in Today's Financial Climate. So Dave, what financial climate are we facing now?
It's an uncertain financial climate, Jack, as you can see from the headlines. We've had the highest interest rates that we've had in 30 years. We have huge inflation. We haven't seen inflation this big for 50 years. You have a lot of risk aversion in the financial markets where people, whereas they once saw the glass as half full, they now see it as half empty or completely empty. And you almost have a resetting of market priorities, whereas up until this past year, companies were encouraged to grow at all costs. But now companies are being encouraged by the stock market and all the analysts to focus on cash generation instead of growth. So there's been like a sea change in the financial markets, and it's been significant.
So do you see this in the middle market similar to the large cap market?
Good question. Less prevalent in the middle market, primarily because these companies have been growing pretty significantly. They stayed lean during the pandemic years. Some of them are still dealing with higher prices and a weakening of demand of their top line, but most middle market companies are doing well because they're smaller and they can be more proactive. However, middle market lenders are much more cautious now than they were a year ago, and it is harder to raise financing because of the general economic malaise that we have. Like, even though the economy is still growing, if you look at the fourth quarter statistics, a lot of chief credit officers at a lot of banks that control how much money gets put into the middle market are quite negative right now.
So while it's harder to raise financing, there are still lenders putting out financing acting as safe harbors. What types of lenders are these?
So the types of lenders that are putting money are the non-traditional lenders. So as you think about it, as banks are receding and pulling back their liquidity, it creates opportunity for everybody else to jump in. So these types of lenders would be non-bank asset-based lenders who can lend against receivables, inventory, and real estate and do a small over-advanced term piece. They're being very aggressive right now. And the banks had basically taken a lot of their market share over the years, so it's now their time in the sun. You also have private credit funds, such as people that will provide a mezzanine structure or a unit tranche structure who are well positioned, because many of these people were kind of kept out of the market by banks being overly aggressive, as well as a lot of the government funding that went on, PPP loans, as well as the Main Street loans. So now that this government funding has kind of withered, it's no longer there, they can come back into the market. And there's also the private credit market has really grown, and there's been a lot of new funds that have formed that are sitting on billions of dollars of AUM. And so I think a lot of the newly formed funds are also quite keen to put it out, whether in an asset-based structure or a mezz or a unitranche. So there definitely are safe harbors. They're not banks, and the banks are less aggressive, so you have to look a little bit harder. And your relationships, most businesses in the middle market don't have relationships with these types of lenders, which makes what we do quite valuable for them.
Are these rates higher across these lenders?
Yes, for all floating rate instruments, the rates have gone up, as SOFR has gone up significantly. For the fixed rate lenders, the increases would be certainly less than the floating rate. The floating rate, whatever the Fed has increased 300 basis points with all their moves, and more moves coming this year, they've all gone up an equal amount. But the fixed rate lenders will have gone up a smaller amount because they're a little bit more inelastic to the interest rate environment.
And is it a good time to look for financing?
See, that's the $1 million question, Jack. I think if your company has performed well and you would be considered a strong deal in a recession resilient industry, it's a good time to look for financing for the following reasons. The safe harbors that are putting out capital right now, they are all looking for better deals. So if you qualify as a better deal, you're going to have competition for that better deal, so you can drive the pricing back down again. If you're a marginal company, if you've been limping the last couple of years, it's probably not the best time to be looking for financing.
Well, there you have it. Thank you for watching our webinar, and we look forward to seeing you next time in the Attract Capital webinar series.
Take care, everybody.